Okay, let's get into your pro picks, some of your high conviction ideas. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, your first pro pick, JoAnne, is TJX. So we talked about that. You own Target, but TJX, that has been a home run.
Yeah, so TJX is even better than Target in the sense of it being two things. One, it's popular. People love to go bargain hunting, whether it's at Marshall's or TJ Maxx or the home goods store. It offers not just sort of quality, but premium stuff. You can find Le Creuset, pans. You can find, Boss clothing. You can find Theory clothes. So you can go into one of the TJ Maxx brands stores and find really great product at low prices. So in terms of the ongoing, enthusiasm for shopping, that's something that's always been there. But if the economy does slow down, again, consumer budgets get a little tighter, you find folks like with Target, but even more so, shifting from Nordstrom and Macy's and going to find those same brands they would find there over at Target for a much more attractive price. The second aspect of the benefit of a slowdown for TJ Maxx is that the source of the stuff they sell is the excess inventory from stores like, Saks, Nordstrom, Macy's, and other high-end department stores and, individual brand name retailers. That excess inventory gets sold off at very low prices to companies like TJ Maxx and other off-brand retailers. And so they get a cheap source of goods and they get to sell them at a time when their traffic into the stores is rising. And so great opportunity. It's a great sort of recession play because both of those things happen at the same time. More foot traffic, and they get a good supply of stuff to sell. So opportunity for investors to have something in their portfolio that not only has some solid growth in normal times, but is also a good buffer against recession.
Is it expensive? Is it too expensive? 27 times earnings?
I don't think so. I mean, think about where the market is. And even the market extracting the top 10, it's more expensive than those, but it's so resilient. That means that it's less volatile. And you're willing to pay, as an investor, you should be willing to pay extra for stocks that are less volatile, right?
Good perspective. Your second one, less of a household name, is Quest Diagnostics. Also a nice chart over the past year. It's up 17%. In 2025, it's outperformed the market. Diagnostic testing.
Yeah, it also has a decent dividend yield. And the reason why we like Quest Diagnostics is, it is one of two laboratory services providers, right? The other is LabCorp. And so if you get any blood work done, chances are your doctor's office is using Quest Diagnostics or LabCorp. So nice duopoly. The other option for lab work is potentially in-house stuff at hospitals, but that has been falling over time. And when you look at, demographics, right? Baby boomers are all getting older, right? They're getting more lab work done, whether that's routine stuff at your annual visit or because you have some mystery ailment that needs to be investigated. So the demographics play very well into Quest. And it's also really impervious to the tariff risk that you face. So it's a good domestic play, not subject to tariffs, and it's really inelastic demand.
And it seems like the thing that's hitting the insurers, which is more people are going for testing,
exactly, is
actually quite beneficial to a Quest Diagnostics.
Yeah, it's definitely information that says, okay, yeah, the lab companies are going to be doing well, given how much we're seeing use of healthcare services.
You mentioned you spent the bulk of your career, or a lot of your career, as a semiconductor analyst. You've had a fascinating career, by the way. Economist, academia, semiconductors. I don't feel like there's a lot of semiconductor analyst economists out there. So it's been great. It's been great to get to know you. So your third pick is close to home because you are that semiconductor expert. It is Broadcom, ticker AVGO, and it's at an all-time high.
Yeah, so Broadcom is, I've actually known this company. It was called Avago. When they went public, I was a semiconductor analyst at the time, and I was at a small investment bank. And we actually were part of the selling group, so we were part of the IPO. I've known them since before they went public. I've known Hock Tan for forever. The value of this company is the areas where they have become proficient. So what this company does is they pick a space, and by the way, Avago, right now Broadcom, was spun out of Hewlett Packard indirectly through Agilent. So they were the chip business behind Hewlett Packard way back when. They have a unique technology. It's not like Intel chips. These are an unusual type of chip, very hard to make, very human capital dependent. That is skills and knowledge, and they have the deepest knowledge. So that's why they're in the iPhone, the high-end iPhones with their particular technologies. But they went beyond that. And they built over time a really diversified company. They're in not just chips, they're in networking technology that Cisco buys and uses. They are now also doing cybersecurity. They're doing software of other types, enterprise software. And most recently, people may know them because they co-design chips for AI computation. So they are known to be a co-designer with Google for their specialized chips for running AI workloads in the data center. And they have been talking about this for the past several quarters, and it's really opened up a much larger market than what they had before. But that still leaves them, again, in every area in which they operate, they're either number one or number two in the market. They're not a high growth company in terms of their revenues, except now for this AI business. They like to be in moderate growth businesses where they are the leader or the second leader, and they have very high margins. Their CEO is the architect of this company. He's done several acquisitions over the last, I guess it's been 20 years now. And every time he buys a company, he has borrowed a lot of money, buys the company, and he pays down that debt faster than they guide for, faster than they tell you they're going to. And therefore, they deliver higher returns on those investments than people initially expected. And that's what's helped power the stock higher. It's a great example of a company that I like to use when people say, oh, I missed that one. I can't own that because look at how much it's gone up and it's at an all-time high. When I covered the stock as a semiconductor analyst, I think the stock was $20. And then I went to 35 and people said, oh, I missed it. And I would say, you haven't missed it yet. This is a company that's going to continue to grow. So be careful about avoiding stocks that are at highs if they have the fundamentals to continue to push growth and their market size higher over time.
It's been an absolute beast of a stock, joining the $1 trillion club in market cap. And it's not been a rising tide situation. The semiconductor index is actually down over the past year. And Broadcom is outperforming Nvidia, which takes up a lot of oxygen, but hasn't performed as well as Broadcom.
It's important for investors to recognize at this point that there is a big growth driver globally, right? Everybody's talking about artificial intelligence, but I don't know that people fully appreciate that we're just at the early stages of the rollout of AI capabilities. There's survey work done by the U.S. Bureau, BLS, Bureau of Labor Statistics, that looks every couple of weeks and asks firms how much are they using AI. And that has gone from 0 to about 9% of survey recipients. And that's, therefore, we're just at the beginning. And we're seeing AI start to be used in service companies and software companies, in financials, right, to make their workers more productive, to make their products different and more capable. And so companies like Broadcom, Nvidia, AMD, and then a lot of software companies are building the capabilities to do this, obviously at places like Microsoft and Amazon and Google. And so I think there's a lot still to come. And that growth engine is likely to be impervious to things like the tariff problem, right? Things like geopolitical risks. And that's why I think the S&P 500 is at an all-time high. It's because those companies and that future potential is dominating the market, right? Those top 10 companies, of which Broadcom is one, is dominating the growth potential. And so for the long-term investor, right, owning some of these companies, not to the extent that they're sitting in the S&P, I wouldn't own 8% or 7% of Nvidia in your portfolio, right, or put your portfolio that much in any one company. But it is, I believe, the long-term growth of the global economy, and it's worth having some exposure to that.
What a great way to end the show, JoAnne. It's been an absolute pleasure to speak with you, learn about you, and get your take on the stock market.